bring on board Robert Pryor, Head of India and Southeast Asia Economics at Credit Suisse. Robert, hi, morning. The IIP as well as the CPI numbers have been disappointing so far. What are you expecting from WPI?
You're right. I mean, we had both a downside surprise on industrial production and an upside surprise on consumer price inflation. So not a particularly nice combination. I'm hoping actually we'll get a better number in terms of wholesale price inflation today. I'm looking for a slight fall in the headline WPI rate to about 4.7, 4.8%, which, bearing in mind the big fall that we had the previous month, that would be pretty good news, I think.
Robert, considering all these numbers which are not looking pretty and recent rupee weakness, does this reduce the chances of a rate cut on Monday, and do you think Reserve Bank of India is likely to hold rates now?
Yes, I think the RBI probably will hold. I mean, actually, even before the latest bout of rupee weakness, I was not expecting a move on Monday. I just thought that the high, sticky level of consumer price inflation combined with the very disappointing April trade deficit number was going to mean that the RBI delayed action. And of course, given what's happened to the rupee, I think that the chances of a move are actually pretty small now. That's not to say we're at the end of the rate easing cycle. We're looking for still another couple of 25 basis point rate cuts later in the year. My central forecast remains that the next move will come at the end July meeting.
Robert, will rupee's movement have a larger influence on the future course of monetary policy than growth worries?
Yes, I think some of the growth concerns are fading a bit. Certainly the RBI hasn't paid so much attention in their monetary policy statements to growth recently. More a focus on inflation and the trade deficit increasingly. The current account deficit has taken centre stage. And of course, actually, the RBI was worried about the current account deficit, given what it may imply for the rupee, and I guess in some senses they've been proved right. The reason why the rupee has been impacted more than most other Asian currencies is that it is one of the few Asian countries to have a current account deficit. In fact, it has the biggest current account deficit quite comfortably within the region. So I think, yes, the rupee is going to take centre stage at this particular meeting. But that's not to say, again, that will remain the case. I mean, if we see the rupee rallying, and I think we may well do in the short term, then again, I think the focus will switch back to inflation and, to some extent, growth as well.
So where do you see rupee settling? Is it 60 against the dollar?
60 is a possibility, I think. In the longer term, I mean, I think to get to 60, say in the next month or two, would require another heavy dose of bad news, most probably coming through from the US. If we don't have a particularly helpful set of comments from the US Fed following their meeting in a week or so's time, then I think that could cause another big leg down, trigger another big leg down in bond markets, which inevitably will have knock-on implications to the likes of India. But that's not a central scenario. I think my guess is we will get actually some rather calming comments from the Fed. And in the near term, we may well see the rupee rallying back towards, 50, certainly 57, maybe even a little bit lower than that, 56.5. Longer term, however, I find it difficult to be structurally optimistic about the rupee. The fact is that the current account deficit is structural. The fact is that India requires a lot of funding every month, every quarter to finance that current account deficit. So in general, we are, I think, looking at a structural downtrend, structural depreciation trend in the rupee.
Right, so what do you make of Fitch upping the outlook for India from to stable now from the earlier negative, and would you agree with that?
Yes, I do. I think it is a reasonably calming move, perhaps quite helpful in this sort of current environment. I suspect more than anything else, it's a pat on the back really for what the finance minister in particular has achieved since he returned as finance minister. Trivandrum, has clearly done a number of things that have pleased markets, that have pleased the rating agencies as well, reassured some of the nerves there. In particular, the moves to open up various sectors of the economy to greater foreign investment, the moves to clamp down on the fiscal deficit, which was threatening to run out of control, and also some of these moves to open up the bond market to greater foreign investment, to increase subsidised fuel prices and so on. All, I think, have contributed to this move, and I think it is justified.
Robert, so what steps can the government take to stem the fall in rupee? The finance minister press conference yesterday failed to calm the nerves. I mean, it was just a statement of intent. Nothing big bang came out of it.
Well, I think in a sort of short-term sense, intervention is or can be reasonably effective, particularly at key trading levels, technical levels for the currency. And the RBI has been more active recently than it traditionally has over Super Al's term. But frankly, intervention is only a short-term cure. You can't fight the fundamentals effectively. At the end of the day, the fundamentals are going to have to improve, and that's why it is important that we get further reforms from the government, and that's why I think the market was disappointed by Trivandrum's speech yesterday, that he wasn't more clear in terms of what he hopes to deliver. One problem here, of course, is that what he can deliver is not entirely in his own hands. As we all know, the Congress doesn't have a majority, the governing coalition does not have a majority. It has to rely on other parties, and those other parties won't necessarily support India in what might be termed pro-market changes. So it's a difficult job, and as I say, unless there are fundamental improvements, it's hard to be structurally positive of the currency.
So, Robert, I mean, the government is also considering hiking FDI limits. Can that help the rupee recover, or will it be beneficial only in the long term?
It's a longer-term measure, to the extent it's successful at all. I mean, obviously the government has already opened up a number of sectors to greater foreign involvement, in particular the multi-brand retail sector. So far, the responses from foreigners has been, to be frank, fairly underwhelming. But one suspects it does take time. Foreign investors need to look closely at the markets. They need to look closely at the conditions that have been imposed on them to invest, for example, in multi-brand retailing. It's never going to happen overnight. So, in the long term, yes, I think it will help bring in, these measures will help bring in more FDI, but it's again, I doubt it's sufficient to really turn this currency around in any sort of fundamental sense.
Robert, a weak rupee also dashes hopes of a current account deficit coming down. What can be done to bridge this?
Well, the impact of the currency on the trade position is complicated. Certainly in the short term, a weaker rupee by raising import prices, particularly for commodity-related items where demand is not very sensitive, does hinder the current account. Over the longer term, however, weaker rupee does boost export volumes and depress import volumes, at least in the margin. And actually, I think we've still to see the full benefits of the previous big decline in the rupee, let alone the one that's happened recently. So my feeling is that actually the rupee is going to be of help to the current account deficit. Is one factor I think which will mean the current account deficit improves a little bit from here. But again, it's a structural problem India has, and until those structural obstacles to manufacturing export growth, for example, are dealt with, then the current account deficit is going to remain pretty large, and therefore the currency pretty vulnerable.